Welcome to the Allan Small Financial Show. As always, I want to thank all of you for taking the time out of your busy day and spending it with us. We have another great show for you today, a fantastic guest. How many of you out there are wondering about gold? Should you be owning gold? Should you already have owned gold? What about the volatility in gold? I've been talking about gold for quite some time. The ups, the downs, there's a lot of them. Some people are calling gold a safe haven. I'm not so sure about that. Well, we're going to be talking about an expert in the gold area or the investment in gold. And David Garofalo, CEO of Gold Royalty Corp, will be with us. I had a chance of catching up with David this past week. David's located out west in BC, and he was kind enough to join us and answer our questions with respect to gold and how investors should be looking at gold right now, even with these just the crazy run on the yellow metal that we've seen over the last year, maybe even longer. So we'll be going to that interview shortly. We're also going to talk about a bunch of other things as we always do. Let's put those topics up for our show today. There they are. As you can see, gold surges in 2025. An interview with David Garofalo, Chairman and CEO of Gold Royalty Corp. As always, our second topic and probably our most watched topic or watched segment on social media channels, top 3 things individual investors should be considering before they make their investment decisions over the next couple of weeks. As always, we will bring you 3 things that you should be watching. Trump announces a 10% tariff in retaliation for Ontario anti-tariff ads. And this has been a very hot topic over the last few days. It appears as though the Premier Ford, has taken down those ads that were going. I didn't see any ads here in Canada. I believe they're all in the US. I know that some of those ads went viral all over the world, in fact. But since then, the Premier has taken down those ads as President Trump wasn't too happy about them and instituted another 10% tariff on goods that are already receiving a tariff when they move into the United States. What is a K-shaped economy? We've heard other terms before. K-shaped is something we don't come across often. We're going to talk about what a K-shaped economy is and what it means. Prime Minister Carney delivers primetime pre-budget address. He mentioned in an address to the nation, to the public, what he is going to be talking about in the upcoming budget in the next week or so, what to look for, what to expect. He mentions a few things, and we'll highlight those on our show today. Quick hits. These are 3 things that I've seen in the news over the last few weeks that I just wanted to make a quick commentary on. And as always, we find these interesting, and we hope that you find them interesting as well. And last but not least, your questions. If any of you have any questions during the show, please put them in the chat boxes. We will pick up those questions during the show and either get to those questions at the end of the show, or we will answer them on our next show. So without further ado, let's move forward with our interview with David Garofalo, Chairman and CEO of Gold Royalty Corp. I'd like to welcome David Garofalo, Chairman and CEO of Gold Royalty Corp. David was named Mining Person of the Year in 2012 by the Northern Miner. He was also Canada's CFO of the Year by Financial Executives International Canada in 2009, Top Gun CFO by Brendan Wood International 2009 and 2010, and he was recognized by IR Magazine for Best Investor Relations by a CEO in 2011. David is kind enough to join us from Vancouver. David has appeared on our show a couple of times already. I think the last time was the spring of 2024. And delighted to have David back again. David, thanks for joining us.
I'm delighted to be here, Allan. Thanks for having me on.
Hi, and I apologize for the voice, just coming off a bit of a cold. But I guess the last time you and I spoke, interesting, gold was $21.60, $21.50 an ounce back then. Over the past couple of weeks, it peaked out in and around 4,400, just under. And as you know, it's risen dramatically in 2025, the price of gold, that is, almost 50% higher year to date. So I guess, what are your thoughts on the current surge, and why do you think it's happening now?
Yeah, I think there are a number of macroeconomic factors behind it. I'm not a gold bug. I'm actually trained as an economist. That's my background, and became a mining guy about 35 years ago. So I just look at economic fundamentals, and gold is a currency, not really a commodity. I mean, people think of it as a commodity, but the reality is for millennia, it has been a currency, and it's a currency that can't be printed. It doesn't subject itself to the whims or control of any government in the world. It's the most liquid currency in the world. It's the most recognizable currency with intrinsic value has been recognized for many generations. And really, what it's reflecting is the debasement of our paper currencies, and that's really a function of the significant amount of debt that we've seen strapped on globally at the government level, corporate level, personal level. And really, the only way to deal with that debt is to print it away, and that's what governments have been doing with exponential increases in paper money supply really going back decades, 50 years since we abandoned the gold standard back in the early 1970s, but accelerated since the great financial crisis about 15, 16 years ago.
So it's interesting you call it a currency. And one of the questions I had, I was going to ask you a little later in our interview. I think maybe I'll ask now because one of the things I struggle with is gold and why people buy gold. You call it a currency, yet not that I know of, but you can't take a bar of gold and walk into a grocery store and buy groceries. Last I checked, you can't, walk into any store and buy any item. So for me, owning gold is difficult to understand. I struggle with that because really, other than jewelry, it doesn't really have much industrial use. So I always come back to the fact that maybe it's a trading vehicle. Maybe people own it as to trade it. When the environment is right, you get in. When the environment is looking a little bit not as good, then you get out. So I guess keeping with your comments about currency, why do people buy gold? Like I just don't understand that because I don't look at it obviously as a currency because if it was a currency, you could make purchases with it. So what do you mean by gold as a currency?
Well, it's interesting you mention that because if you walked into your local Loblaws with euros and yen, you wouldn't be able to buy groceries with those either. You'd have to go to the bank and get those exchanged into Canadian dollars. For that matter, I was actually in Morocco for vacation a few weeks ago with my wife, and I had Canadian dollars in my wallet, and I couldn't do anything with those. I couldn't even exchange them into the Moroccan currency. So the reality is you have to go to the bank to exchange currencies in order to be able to transact anyways. It's no different than for gold. Gold, you'll have to go to the local bank and buy your local currency. And the great thing is gold is the one currency you can take at any corner of the earth and you will get local currency for it. You couldn't say that for the Canadian dollar for that matter, or for some of the other more exotic currencies globally. So it's a far better currency than any fiat currency that we have on earth right now. And the other interesting thing, economic history has demonstrated that each and every fiat currency ever created by man has ultimately failed because the temptation for governments and central banks to debase that currency is just too irresistible, particularly when you're dealing with the debt levels that we have globally. The temptation to debase the currency, to debase the debt is just too great. And there is no fiscally responsible way for us to repay the debt that we strapped on. And so that's really what's driving the gold price up. It is an agnostic barometer of the intrinsic value of our fiat currency. No government can control it. No government can print more of it. And so it's just telling us that our fiat currency is seeing a debasement. And in fact, if you look over 50 years from when we abandoned the gold standard back in the early 1970s, the gold price has gone up 150-fold in that period of time. The purchasing power of our own currencies in North America have gone down about 99%. So it's a very linear relationship over that long investment horizon.
Interesting the way you look at it. I guess you have a point. You would have to take your gold and exchange it for whatever the currency is of that country, just like you would dollars, Canadian dollars into, like you said, the currency in Morocco. I guess many Canadians own gold as part of a diversified portfolio, and they use it as a hedge, right? You hedge against the U.S. dollar, hedge against the U.S. economy. Do you think it's an effective hedge? And I ask because we've seen gold move higher, price of gold move higher, and U.S. dollars move higher at the same time. So is it an effective hedge, or is seeing both move up at the same time normal, or is that unusual?
Well, it's true. I mean, we actually have seen the gold price appreciated more recently, I would say over the last several years as the US dollar has appreciated. But lately, we've seen the US dollar actually depreciate against other major currencies, and the gold price continues to march up because the reality is the US dollar is a paper currency like the euro, like the yen. And yes, they will trade up and down relative to each other. But in aggregate, when you look at a basket of currencies, they're all depreciating against gold because gold is not increasing in supply. It can't be increased in supply. There's a remarkable elasticity of supply to price because mines are so difficult to build. We're seeing how difficult it is to build major projects here in Canada in terms of getting First Nations consent, government consent, and whatnot. And I know the Carney government's trying to cut through the red tape, but the reality is these are capital intensive exercises with a lot of social intensity around them as well. So we can't really bring on new supply in response to the gold price. So gold really cannot be manipulated, whereas the paper currencies can be and are debased continuously through the printing of increased paper money by central banks globally. So yeah, they trade up and down relative to each other, but the reality is against hard assets that are finite in quantity, these currencies are being debased.
Yeah, no, there's no doubt about that. All the borrowing, the more the US seems to borrow, the more gold seems to be going higher. I've heard a number of clients call, especially lately, gold a safe investment, which is interesting. And I'm not sure what people's definition of the word safe is. The word safe means different things. Do you think that gold is a quote unquote safe investment? And how would you think of gold in relation to other investment classes like stocks or bonds or even crypto? What would your comments be? Like you mentioned, finite. Well, crypto, I know there's only so much crypto in the world. And how would gold compare to crypto and other asset classes?
Yeah, look, I think without comparing one asset class to another, because I'm not a portfolio manager, you are, and you have much more expertise. But I would say most portfolio managers would tell you you want to diversify your portfolio, you want to have exposure across multiple asset classes in order to get optimum risk-adjusted rates of return. And I see gold as kind of an important element of a diversified portfolio when you look across the various asset classes that you can buy. I think the difference between crypto and gold is gold does have physical properties. It has been recognized as a currency for 4 millennia. It is an indestructible element out of the Earth's core. It is an important diversification tool for central banks. To date, I have not seen central banks buy crypto in any significant quantity. They still buy physical gold because they're recognizing that owning U.S. Treasuries, for example, does not cover the cost of inflation. The yield on those U.S. Treasuries, the reality is inflation is well above what the headline numbers might indicate. I think we're seeing that in our day-to-day lives. Our purchasing power is declining much more rapidly than the headline inflation numbers are indicating. Gold's reflecting that, right? And central banks are buying it because they are not getting real yields, positive real yields on their treasuries or other sovereign debt that they might own within their central bank reserves.
Would you call gold a safe haven or safe investment? I think that's the term that I'm struggling with for investors. To see gold, I think it just today alone, I saw it at one point down 60, $70 an ounce. I just checked before we started talking. I think it was only down three. The other day it was down 200. So just difficult, as you said, when I talk to investors, they're calling it, well, they'll say, maybe we need some safe investments. And they'll say, what about gold? And I look at that and I cringe a little bit because it's just so volatile. So, what would your comments be on the volatility of the price?
Yeah, you're absolutely right. In the short term, there is a lot of volatility around gold, but over the long term, it's actually been the most stable investment you could imagine. Over a 50-year horizon since we've abandoned the gold standard, we've seen a 150-fold increase in the gold price, and that's been entirely reflective of the debasement of the purchasing power of our currency. To put it into very visual terms, a gold bar, which is probably several $1 million in value 50 years ago bought you a nice house. Today, it buys you a nice house. And an ounce of gold 50 years ago would have bought you a nice suit. Today, it buys you a nice suit. It has retained its purchasing power in the most visual terms you can imagine, the most tangible terms you can imagine.
So you're saying, I guess, it keeps up with inflation. It is probably the only thing that keeps up with inflation. So I guess in that respect, it makes sense to own because as we know, you're not going to buy or own a portfolio that has 50% gold in it. You
No.
might own 10% or whatnot. So a hedge against a weakening or chaos in the markets, it doesn't really work because you just don't own enough of it to be able to effectively hedge when other things are going down. Even if your gold is going up, it's probably only a small portion of a portfolio. And so for investors to understand that is what I've been talking to them about. I guess what I wanted to end off with a question with respect to exposure to gold.
Hmm.
For someone, how do you recommend if you were going to buy it? How would you recommend buying it? Would you recommend buying physical gold, like you said, gold bars? Would you recommend ETFs, mining stocks, certificates? What do you find most investors that how they're buying gold, and how would you recommend if you have a recommendation? How would you recommend owning gold today?
Well, there's never been more ways to own gold than occurred today, or it occurs today. About 20 years ago, there was an ETF introduced on the New York Stock Exchange that's physically backed by gold. Up to that point, you had to actually line up at the bank and buy physical gold, find a way to store it. So it was rather inconvenient. And now there's a very convenient way to own physical gold through the ETF. I think it's called the GLD on the New York Stock Exchange. And that's created a lot of physical demand for gold that didn't exist 20 years ago, but also opened it up to pension funds and mutual funds that couldn't own physical commodities, but they can own an exchange traded fund, an ETF. And so that has opened up a much broader array of investors that couldn't participate before. But if you're looking for leverage to the gold price, typically you're looking for gold equities. And the gold equity should offer you the prospect for outsized increases in profitability per ounce relative to where the gold price. So if the gold price goes up 100%, presumably if costs are stable for a producer, they should see profits go up 200%. So that's the leverage proposition that equities offer. Of course, when you're owning a gold equity, a producer, they're not immune from inflation that we're experiencing in the general economy. So that leverage proposition doesn't necessarily always translate as efficiently as you might hope. And that's why, I've been building and operating mines for 35 years. When I got back into the gold space about 5 years ago, I ended up founding a royalty company because that does provide unmitigated leverage at the gold price. And there's a number of royalty players out there that you can buy because they offer you top line exposure at the mine site. You get a percentage of the revenue from a mine, but you're completely insulated from costs at the mine site because you're getting a percentage of the gross. That's the beauty of the royalty business. It also gives you leverage to the exploration being undertaken by the operators that own the mine without actually having to contribute to their exploration budget. So it's the purest leverage play on gold that you have. And that's why, again, I founded a royalty company. I was concerned about inflation, and that did rear its ugly head. I didn't anticipate that COVID would cause it, and nobody predicted COVID, but that was definitely the match that lit the dry wood in the forest, and it caused significant inflation that unfortunately mining companies are experiencing along with the rest of us in our day-to-day lives. So I would say if you're looking for leverage, I'd buy a royalty player over a producer.
I guess if you had that crystal ball, where would you say gold's going? Obviously, I'm going to assume over the long term higher, but in the short term, would you anticipate a bit of a pullback here? I know obviously it's tough to say, but it's come so far so fast, and I think we're all a little bit spoiled and thinking that this run will continue. At some point, I would imagine things in the U.S. will stabilize with respect to trade, tariffs, maybe even debt come down based on paying off some of that debt as the president wants to do. Do you think gold in the short term will continue this crazy run that it's been on, this amazing run, or do you think we could see a bit of a pullback in the short term?
Yeah, nothing goes up in a straight line. And as you correctly pointed out earlier on, Alan, we have seen a lot of volatility in the gold price over a 50-year horizon, but the direction has been unrelentingly upwards because the direction and purchasing power of our underlying currencies has been unrelentingly downward. And that's not going to change. That longer term dynamic is irrefutable and irreversible given the amount of debt that we have to deal with at the government, corporate, and personal level, is just going to have to be inflated away. So gold will continue to go up, but with some volatility in the interim period. That's unavoidable. That's just the nature of a very liquid commodity like gold, a lot of buyers and sellers in the market, and it always leads to short-term volatility in any commodity that's as liquid as gold is.
Yeah, no, for sure. And we've seen a lot of volatility over the last couple of days. It's amazing to see gold move as much as it has, and I know a lot of investors are excited about it. So, David Garofalo, Chairman and CEO of Gold Royalty Corp, thank you so much for being with us once again and talking to us about this precious yellow metal that everybody is talking a lot about over the last few days. And we'll see. Maybe next time we talk, gold is a lot higher from here. So, thanks again for joining us. Much appreciated.
Thanks for having me on, Allan.
A fantastic interview with David. As you can see, David calls himself an economist. He says that's what he has been trained for and what he does. He's an economist still till this day, and I know he runs the Gold Royalty Corp business, but definitely very knowledgeable about economics and what's going on in the world. So it was great to get his insights why gold is, or what he believes is, an alternative to the U.S. dollar, a currency in essence. We felt we wanted to ask him about that. Very important to understand why people are buying gold right now, why investors are buying gold, why central banks are buying a lot of gold right now. So fascinating interview. We hope that you enjoyed it. Now we come to the part of the show where we talk about three things that individual investors need to focus on before they make their investment decisions. As you can see, here are our topics for this show. Will the Fed cut interest rates this afternoon? We will have a Fed decision in a few hours. The talk is that interest rates will drop another quarter point. We're going to discuss that. Tech earnings this week. We've already received the big bank earnings out of the US. We've received a few earnings here in Canada, not much as yet. Rogers, for example, has reported earnings. Celestica reported pretty good earnings as well recently. But now we're moving into the big tech space, the big cap tech names. Let's talk a bit about that. US President Trump and President Xi of China will meet this Thursday. That is what is on the docket. They will meet out in South Korea, and definitely headlines from that meeting will be market moving. There is no doubt about that. We know that anytime we talk trade between the US and China, that alone is market moving. Not to mention them meeting, I think, for the first time in quite some time. I think it's been a few years for sure since since President Trump's first term, and we'll see what headlines come out of that. So these are the three things that I think you need to focus on, and then start by delving into each one on their own. So first one, will the Fed cut interest rates in the next few hours? And this is something I think the market is pretty much taken in stride. You know, the fact that they're going to cut interest rates 1/4 point at 2 o'clock this afternoon, and we'll hear what the Fed has to say after that. But I think the question more for the Fed will be, what will they do in December? They do have one more meeting this year. We know that the Federal Reserve and what they do with interest rates is far more important for the markets than what the Bank of Canada does here in our country. We know that what the Bank of Canada does definitely affects our dollar, but what is the Fed going to do? And will they cut once? Will they cut twice more before the end of the year? And that is what right now is the question that is on the table. And what will the Fed use? I guess, well, it's tough to use any economic data or any data that's released out of the government, because the government in the United States is currently shut down. So the only news or the only data that they've received recently is CPI data. Inflation data was released recently out of the US. It was collected just before government shut down, and it was released. And we're going to be using, or I should say the Fed will be using that data as part of all the other data that they have to make their decision. Our first chart shows what the inflation rate is. The consumer price index in the United States, as you can see, coming in at 3%. It's been hovering around 3% for a little while now. I guess it was just below 3, and now it's come up to 3. and it's been there for the last few months. Our next chart is a bar chart, which shows U.S. Consumer Price Index on a monthly basis. And you can see here that 0.3% is what the last reading was. And again, is it anything that wasn't expected? No, it came in roughly as expected. Our next chart is one that I find now a little bit more interesting than we found before. And this is the Fed policy interest rate chart. And you can see here, there it is. You can see a little bit of a tick down. And that was the last interest rate decision that the Federal Reserve had, bringing down the rate to 4.25. Yes, keep in mind, in the United States, they do have 4.25. They have a range versus everywhere else where they just give you a rate. In the United States, it's more of a range. And why I find this so interesting right now is that, is the new rate for the Fed, they talk about their target for inflation being 2%, 2%. But is the new 2% 3% in the United States? Well, one would say that's not true. I think if you ask Jerome Powell, he would say, no, our target is still 2%. Well, and my question would be, then why are you cutting interest rates when the rate right now is 50% higher than your target rate? How does that make sense? And I think that's a question that the Federal Reserve would struggle with. They're going to answer it by saying, well, they have a dual mandate, which is right now they're focusing more on jobs and jobs growth than they are on inflation. And the readings that they've been getting is that jobs growth is quite weak. And so they want to focus on that. Cutting rates hopefully will stimulate and produce more jobs. So interesting that we see this tick down. So is the new 3% the target? And they're just maybe not sharing that with us. I guess time will tell. Our last chart in this for this segment, for this part of the top 3 things to consider before you make your investment decisions, is what the probabilities are that rates will be cut going forward. You could see 96.7% that there will be a rate cut today. Only just over 3% that they will stand pat. More importantly, as I said, will they cut in December? Well, if they cut now, it looks like they have a 90% chance that they're going to cut in December. So we're looking at, chances are, to see 2 rate cuts before the end of the year. And then we go into early next year, and you're looking somewhere around 46% that right now that they will cut again come the end of January. So the probabilities are definitely there for rate cuts. We'll see if the Bank of Canada follows suit and cuts twice as well. We're not sure, but we'll have to see how that goes. But keeping an eye on what the Fed does is extremely important for the markets. And when that inflation data came out, the market breathed a sigh of relief, saying that basically, if with inflation coming in as expected around 3%, the Fed has a green light to cut rates. And obviously, that's good for the market. Second thing to focus on, tech earnings. We're going to get 5 out of the 7 stocks you see there, known as the Magnificent Seven. They're going to report earnings in the next couple of days after the close today and after the close tomorrow, Thursday. And we've already received earnings from Tesla. They were not good at all, yet the stock popped on the earnings results. I think it was because of the commentary that Elon Musk had with respect to robotics and robo-taxis and all the technology, not so much because of the cars, but because of the technology that is coming down the pipeline in the not so distant future. But we're going to hear from Microsoft, Alphabet, Amazon, Apple, and Meta. We're going to have to wait a little bit for NVIDIA earnings. I think they're coming out sometime 3rd week in November, somewhere around there. Our first chart shows the Magnificent Seven, why they are so important, as we've said in other telecasts. $20 trillion is what the Mag 7 make up of a $30 trillion US economy. And those Mag 7 names alone are bigger than the Chinese economy, bigger than the 2nd largest economy in the world. Mag 7 names are, if you combine all of their market caps, they're bigger than the Chinese economy. So very, very important. You can see here the Mag 7, the chart going from the bottom left to the top right. And obviously, technology as a whole makes up, depending on what parts you include, but overall, I would say it probably makes up about 35, 40% of the S&P 500. Our next chart shows the actual stocks themselves and how they've been faring this year. You can see actually Tesla. Yes, Tesla actually has been the best performer. And one name that you probably wouldn't anticipate, Alphabet. Alphabet has been the best, or the second best, I should say, performer. And then you have a bit of a cluster there of the other names. NVIDIA, Meta, Microsoft, Amazon has been the second worst performer. And many believe, including myself, that because it has been an underperformer versus other big cap tech names versus other Mag 7 names, excluding Apple, that Amazon would be the one stock to take a look at, perhaps, if you're looking at buying shares of a good growth name, one of the Mag 7, and a big cap tech name. Amazon might be the one because it hasn't moved up as high as the other names as yet. I would say when we look at the big cap tech names and we get their earnings reports and we hear the conference calls, the CEOs on their calls, probably the number one thing for the market, yes, aside from how each individual company is doing, what their bottom line earnings are, what their top line revenue growth is, what they're saying, how are things looking going forward. But I would say the number one thing that we're all going to be listening for is spending. Are these big cap tech names, the Mag 7 names that have been driving the AI spend, are they going to continue to spend? And are they going to continue to spend at the rates they've been spending? Our next chart just shows how much these companies have been spending. Look at that CapEx spending amongst tech giants. Upper top is Amazon, and you have Microsoft. Look how that has ramped up from the bottom left, almost in a straight line, up to the top right. Alphabet, Meta in the bottom there, just spending outrageous amounts of money. This is quarterly spending, so you can see between 30 and 35 billion just for the quarter in Amazon, which will take you well over 100 billion in spend. Microsoft coming in between 20 and 25 billion. And then you have, Meta, 20 billion. You have Alphabet, around 25 billion. This is a quarterly spend, and it's unbelievable to see how much these companies are spending on the build out of data center infrastructure, AI, chips. And who's going to be the benefactor of these companies spending all this money? Well, it's going to be the NVIDIAs of the world, the AMDs of the world, and recently, perhaps, maybe even the Qualcomms of the world. They just announced a chip in the last 24, 48 hours as well. So tech names, very, very important. We want to keep an eye and an ear on what they have to say and what they're saying regarding their spending. Our third point to consider before you make your investment decisions is one of more to do with a meeting, right? A meeting between the two superpowers. President Trump, President Xi of China, set to meet in the next, let's say in the next 24 hours or so in South Korea. It looks like their meeting is still, at least from what I know, on track to happen. The groundwork has been set by the Trump administration, the high-level representatives from China, from the U.S. They have already been meeting up in Malaysia, talking about what a trade deal between these two largest economies in the world will look like. So any news, any headlines, anything coming out of this meeting on Thursday, a day from now, will be extremely important. And why will it be so important? Well, our first chart clearly shows how the S&P 500 moves with respect to any trade information or trade updates from these two countries. You can see on the far left, when Trump signed order of tariffs on Mexico, Canada, and China, what happened to the S&P 500? It went down pretty much from the top left to the bottom right. S&P 500 confirmed that it was in a correction mode. You had Liberation Day, tariff announcements. The stock stock market dropped significantly. S&P straight line down right after that. And then we started to see things getting a little better. Many tariffs were paused for 90 days. U.S.-China forged a truce on tariffs. You could see market getting better and better based on those headlines. Deal to get U.S.-China trade truce back on track is done. We kind of fell off the rails a little bit there. We had a bit of a blip. And now today, if you go all the way to the far right-hand side, Chinese and US officials hash out framework of a trade deal. So you can see that the market is moving in lockstep with these headlines. And is it a surprise? Absolutely not. You're talking about the two largest economies in the world, and anything that happens between the two of them will be market moving. Actually, an interesting chart I want to show you next, and that's a chart of technology. And we call it Invesco QQQ. There it is. This is the index, ETF, if you will, that follows tech, big cap tech. And it's if you were to remember that the chart we just had, and you were to put this chart on top of it, it would look almost identical, because what has happened over the last, let's call it 8 months or so, technology has been the one thing that the United States has held over the Chinese, not sending chips, threatening not to send software, not sending chip equipment over to China. All these are things that the US said, you know what, we're going to slow this down because we don't want China, this is the US talking now, to have the best equipment, to have the best chips to match the United States. And so what has happened every time they make an announcement, tech pulls back if it's a negative one. But now the talk is about perhaps a trade deal. And I guess the tech sector is hoping that it's going to involve being some sort of tech deal and allowing chip equipment companies, chip companies themselves, semiconductors, to be allowed to do business in China. And that's the case. We're going to see the Invesco QQQ and tech stocks move a lot higher in the coming quarters. So this is something that, as I said, we want to keep an eye on the Trump and President Xi in China, what they're going to say coming out of their meeting in the next 24 hours. We also want to keep an eye on tech stocks, what they say, how their spending is going. And I guess first and foremost, right away this afternoon, we're going to hear from the Fed. So as an investor today, you want to keep an eye on these three things, because these are the most important things, in my opinion, you should be watching before you make your investment decisions. So President Trump announced a 10% tariff, or an additional 10% tariff on Canadian goods that are not covered under CUSMA or USMCA going into the United States. And that was because of the ad that province of Ontario had out there during the World Series games over the weekend. And just prior to that, it was an ad that talks about how protectionism is not good. It actually showcases former President Ronald Reagan making a speech talking about how tariffs don't work. They may work initially, but over the long term, they don't work. Protectionism does not work. President Reagan was a free trader, and these ads clearly showcase this. Well, when President Trump heard about these ads, it didn't really go too well, and asked Canada to pull the ads. Canada was slow to pull them, and they announced a 10% tariff on our goods going into the U.S. So, unfortunately, I've been asked about this. Unfortunately, it had a bit of a negative effect. But asking, Premier Ford, he thinks it had the actual effect that it had on perhaps government, Republicans, and the people in the United States. He thinks it actually had a good impact, and the impact that they actually wanted. So we'll have to see how things go. Right now, all negotiations between Canada and the U.S. are called off. Canada, according to Prime Minister, is ready to meet President Trump whenever and talk to President Trump once again. Apparently, trade negotiations were going well until this ad was put out there. So we'll have to see how things go. And our illustration for this segment, pretty much the only one we have, is just a timeline of events. There you have it. Ontario airs TV ad featuring President Reagan on tariffs. That was on the 14th. It actually took, I guess, a little over a week for President Trump to say he saw the ad and terminated talks with Canada. Doug Ford agreed to pause the ad campaign on the Monday. On Monday. This was announced on Friday. And on Saturday, President Trump announced the tariffs, and the ad campaign was paused on the Monday. So we'll have to see how things go moving forward. I believe that Canada and the U.S. will get back to the negotiating table. I think right now the president is just doing what he's doing while he's, in Asia. And I think once he gets back, I would not be surprised to see some sort of high-level talks again take place between our country and the U.S. So perhaps this is just a bit of a stall tactic. I'm not sure. But overall, it is obviously in our best interest, in Canada's best interest, and make no mistake about it, in the U.S.'s best interest as well, to get negotiations back on track. What is a K-shaped economy? Well, it's interesting because you look at the letter K, and what do you get? Actually, let's show our first illustration for it. I think that could help people. When you have the letter K, you have the vertical line that comes down, but you also have the two lines that go. One comes from the bottom left to the top right, and then the line below it goes from the top left to the bottom right. And that's the part we want to focus on, the part that this woman is sitting on here, which is showing that the economy is not working well for everybody. It seems that those that are in the upper class, those that are making higher wages, higher income, they seem to be coping a lot better than those that are in the middle and lower class. And that's what we mean when we call a K-shaped economy. And I always say, or I've said many times on our show, is that those that have investments tend to do better when the economy struggles than those that do not. Because obviously we could always tap into our investments if we're ever short money, if we need money to do something. Whereas those that live paycheck to paycheck and don't have as much in a way of investments, don't have an RSP, don't have things like that, they tend to have more of a struggle when the economy is slowing down and the economy is struggling. Our first chart, actually, let's see it here, shows exactly that the top 20%. So wealthy Americans in the top 20% continue to grow their spending. This shows the chart. You can see here that they call it revenge spending in the middle here, that you can see for the middle class and lower income Americans. But that is pretty much over. Now we're finding that middle income and lower income Americans are now just keeping up with the inflation rate with respect to spend, whereas the top 20 percentile of income earners and the wealthier individuals, they tend to spend a lot more. Once again, they have the means to do it, and they are continuing to spend. K-shaped economy. Next chart here shows a tale of two wallets. That is that's an interesting name for it. And on the left side, lower income household spending growth was about 0.6%, whereas that's year over year up to September. Whereas you compare that to higher income peers, their spending growth was 2.6%. You can see the gold line there being the highest out of the three, and that is the higher income, the higher spend. They obviously have more money to do so. On the right side, household wage growth. At one point, a few years ago, it was actually interesting enough, it was the lower income earners that saw a higher wage growth. They were seeing their wages grow faster than higher income earners. And that has since in the last, let's call it year or so, that has actually reversed. And now we're starting to see that the higher income earners, after tax, wage, and salary growth by households, incomes, this is by higher versus middle versus lower, you can see that once again, the higher are growing their income or their wages more rapidly than the lower income earners. And as I said, if you look at the blue line back about a year and a half, maybe almost 2 years ago now, the lower income earners, they were on the top, and now it's reversed. The blue line is at the bottom, followed by the red and then the gold. So it has definitely flip-flopped, and you can clearly see that right now in this K-shaped economy, if you're a higher income earner, if you have a higher paying job, if you are in a, more in the upper class right now versus the middle and lower class, you're definitely finding it a little bit easier to cope with the higher costs of living that we're experiencing in Canada, higher cost of living they're experiencing in the United States. And it just seems that right now, money is helping to grow further money, whereas unfortunately, if you don't have money to invest, right now you are unfortunately struggling. So that's what a K-shaped economy is. And many people believe that we are in the thick of a K-shaped economy right now. So recently, Prime Minister Carney delivered a primetime pre-budget address. He addressed a number of things which I thought were important to bring to all of you. If you hadn't seen his address live, or perhaps you haven't caught it on YouTube or anywhere else online, you could catch it, I'm sure. He talked about many things. I just wanted to highlight a few for us because that budget is coming out soon. He made some, I don't want to call them predictions, but he talked about things to look for in his in the budget coming out in the next let's call it 10 days or so, maybe a week or so. I think it's on the 4th that the budget is coming out. So I wanted to highlight some of those for you this afternoon. First one, and we can pull those up. We have those highlights. There you have it. We call them speech themes. He pledged generational investments, which will be necessary to build the economy of the future. And as we know, he's actually created a whole department to focus on big projects in Canada that's going to help grow our economy. I think a great idea, but we just need to get these projects going. If they're already going, we need to get them to the finish line as soon as possible. Government will build a stronger economy in a more dynamic and more competitive, in a more hostile world. How are they going to do that? Well, I guess remains to be seen. I've talked about on this show and many other TV appearances, BNN, CP24, all of the different places. I talked about continuing to cut interest rates, continuing to cut taxes. This is how you're going to build a more dynamic and more competitive environment for investors to come to this country. Transforming the economy will take some sacrifices, will require difficult choices. We'll have to see what those choices are. He's said that things are going to be a little bit more tough. He's going to cut spending in many areas. One of those areas is going to be in government. He wants to see all the different departments in the government cut back on spending, reduce the size of government in Canada, which is a great idea. I know the Prime Minister is a Liberal, but that tends to be a conservative idea. So great to hear that, talk about spending less in order to invest more, which is the next point. I love to hear that. Nation building major projects to be fast tracked, as I touched on earlier, where we want these big projects, we want to fast track them, and we want to get these going as soon as possible. We need to grow from within. We can't rely on our biggest trading partner to continue to grow. We have to grow from within. And so these are some of the ideas that I wanted to talk about. The last one I'll just touch on quickly. I know there's one more below it, but the relationship with the United States will never be the same as it was. And this was a comment that he has made a few times now, and I think everybody would agree. I think we'll have to see who the next president will be after 3 more years of President Trump, but I just don't think that we will be as dependent or as, I just don't think we'll look at the United States as being as reliable for us, to be there for us. We used to call them our big brothers to the south. Well, I'm not so sure we're calling them that any longer. So we need to get our backyard in order. We need to do the things we need to do to create a better environment for business, to lure business here, to get foreign business here. And we need to do the things that we need to do to increase trade, increasing trade with other countries other than the US. And I think that's what the Prime Minister is going to be focusing on, should be focusing on. And it'll be very interesting to see what comes out in the budget in the next few days. quick hits. Three ideas, three things I saw in the news over the last couple of weeks that I wanted to just make a brief comment on. Our first one here, Americans face a retirement confidence paradox. Do Canadians face it too? This confidence paradox is a lot of individuals think they do have enough money to retire, but unfortunately, they're not doing the right calculations. They're not factoring in things such as inflation, which is a very key component of any retirement plan. They're also in the US not really counting on healthcare costs. So that's something that that has come up in the last couple of weeks that we wanted to comment on. Number two, Musk could leave Tesla if 1 trillion pay plan or pay package is rejected. This is what the chair of Tesla warns. And $1 trillion pay package. Wow. That is something that we have not seen before. And could he leave? I guess anything is possible. A third point or a third thing I saw on the news recently, and these stocks are falling back to earth as Trump and China play nice. What stocks are these? You can see it's a bit of a play on words here. Rare earth material stocks. Rare earth material stocks, we've seen them surge in North America and around the world as the United States takes up an investment position in many of these names. That has caused a lot of these stock prices to move significantly higher. Well, recently, now that China and the US are talking again, and if China can make a deal for those rare earths coming from China once again, perhaps these companies are not needed as much. So their stock price has fallen. Let's go to our first topic or our first quick hit. America faces a paradox. And we have an interesting chart here we can show up quickly, which talks about exactly what I was referring to. How confident are you that you'll have enough money to retire to cover each of the following? And the average, 87%. They're confident that essential expenses will be covered. This is that's the average of US, Brazil, Japan, and Mexico. Brazil actually thinks 90% think that they'll have enough. I like the far right-hand side of this chart, which I find interesting. How confident that you will have to cover essential expenses? Well, if you have an investment advisor or financial advisor, 94% confident. And if you don't have one, it's about 11% less. And non-essential expenses, 86 versus 68. So clearly those, and we've seen these stats before from IFIC, other governing bodies. If you have an investment advisor, you tend to make out a lot better than those that do not have an investment advisor. Our next chart shows about in the US, inflation and healthcare costs are top threats, but only half or less have factored it into their planning. And you can see here in the US that they're the bluish bar. You can see that they're the highest with respect to insurance costs, inflation and living costs, inflation and cost of living, I should say, long-term care, nursing home, home aid. So you can see on the left side, inflation, rising cost of living, 66%. And you can see that these are the costs that are eating into many people's retirement portfolios, and they're just not being factored in. Is that happening here in Canada? I would think the answer is yes. In Canada, maybe not on the insurance or healthcare costs, but definitely a lot of individuals need to factor in inflation, need to factor in the cost of living to be able to predict where they will be in the coming years. Our second topic, our second quick hit, is this idea of a $1 trillion pay package from Tesla and to Elon Musk. Let's show that nice Tesla symbol there. Let's show the stock of Tesla. It's been going higher regardless of what's been going on, although it seems to have plateaued in and around $450 a share, $460 now. But will Elon Musk get his pay package? The vote, I believe, is in the coming weeks, and we'll have to see if he gets his money. If he doesn't, will that mean he will walk away from Tesla? I'm not so sure, but I guess we will find out in the coming days. Our third and last quick hit is the idea of, as I mentioned, rare earth elements. And this idea now that China is speaking to the United States, and the hope is for the United States that they will gain access to the rare earths coming out of China. And we know that China is the biggest in the world by far in processing rare earth materials and sending them out. So they have a pretty big hold on that. There are rare earths all around the world, but it's the processing of them. That's where China is far ahead. And we have one chart here on one rare earth company, USA Rare Earth Inc. and you can see has shot up extremely high when there was talk about the US government taking a position in these rare earth element names. But since then, with the US talking to China again, you can see this stock pulling back. So rare earth material stocks, maybe a name that some of you own, definitely not for the faint of heart, and are definitely quite volatile based on the geopolitics of the day. What's your take? That's the part of the show where I take one of your questions from the audience. And I guess I should say, what's my take on your question? Always have fascinating questions. As I always say, please, if you have a question, put them in the chat boxes. I'd be happy to answer them. I guess perhaps not on this show now, but on our next show. Always looking for some great questions. And question we have today, interesting question. Obviously, this person is follows the markets quite closely, it sounds like, or at least commentaries about the market. Jamie Dimon, CEO of JP Morgan, Sam Altman, CEO of OpenAI, parent company of ChatGPT, and others have recently expressed concern about an AI bubble that will soon burst and bring down the markets. Do you share the same concern? I guess quickly, I don't. I don't share the same concern. I think the last AI bubble, if you look at the stocks or the companies from back then, compare them to the companies as of today, totally different. Those companies were a lot smaller. Many of them didn't even make any money. Many of them weren't even profitable. Today we have large cap, 4 trillion in some cases dollar companies, companies that are so diversified from AI to everything really, to search, to digital advertising, to retailers like Amazon. You look at a name like Microsoft, which is pretty much in every area, software, LinkedIn, they own LinkedIn, so they own social media. These companies are so diverse and so large now that I do not believe we are in some sort of tech bubble. I know that is the fear. I'm not saying we can't see a pullback in these stock prices. In fact, I believe we will see a pullback in the big cap tech name space. I think we'll see a pullback in the markets. We haven't seen one in a long time, and I believe we will see one. But I think it's going to be of the 5 to 10% variety, not anything substantially more like 20 to 30%. So for me, I don't agree or I don't believe we are in a tech bubble. So with that, I want to say thank you for everybody who tuned into our show this afternoon. As always, I hope you were able to take away something from our show, a piece of information, some piece of knowledge that you perhaps did not have before. I also want to say that we'll be back on air 2 weeks from today on November the 20th, November the 12th, Wednesday, November the 12th at 12 noon and across all our social media platforms. And until then, happy investing.